Assalamu alaikum. Welcome to part 2 of Lease Accounting, IFRS 16. So in part 1 we went through lazy accounting, and here we are going to go through a lessor accounting and sale and lease back. A lessor must classify its leases as finance lease or operating lease, right? But in the lessee's accounting, what did we see? We identified lease liability and right of use asset because they are liable to pay the consideration and also they are using the asset, so right of use asset. We recognize it. But when it comes to lessor, what should they write? They should classify the lease which they are giving to the lessee, as a finance lease or operating lease. If it is finance lease, the recognition is different. If it is operating lease, the recognition is different. We are going to go through both the types of leases. Okay. So finance lease is a lease where substantially all of the risks and rewards of the underlying asset transfer to the lessee. Okay. That means that asset is being at the end of the lease, that asset is being transferred to the lessee is the one who is now going to control the asset, going to own the asset. That is known as finance lease. Operating lease is not like that. Okay. Operating lease is where the risk and rewards of the asset is not transferred to the lessee. So after the lease term gets over, he receives the payment from the lessee, the lessor receives the payment from the lessee, and then recognize that. That's it. The asset still remains with the lessor. It does not go to the lessee. So that means the risks and rewards of that asset stays with the lessor, not with the lessee. That is operating lease. Okay. Now, to classify something as finance lease, okay. So IFRS 16 says that lease is probably a finance lease if one or more of the following apply. Even if one applies, it is a finance lease. Okay, more than one also could apply for it to be a finance lease. So all these points are to classify it as a finance lease. Ownership is transferred to the lessee at the end of the lease. Okay. So the main thing is ownership. This is transferred to the lessee at the end of the lease. That is known as a finance lease. So here the lessee has the option to purchase the asset for less than its expected fair value at the date the option becomes exercisable, and it is reasonably certain that the option will be exercised. What does it mean? This is a finance lease, okay, where the lessee has an option to purchase that asset at the end of the lease term, right? But at what amount? At what amount can they purchase that asset at the end of this thing? They have the option to purchase the asset for less than its expected fair value at the day the option becomes exercisable. That means the day when option becomes exercisable means what option? Option is to where the option is that you have the option to purchase the asset. So you purchase the asset. Whenever you purchase the asset, that day you are buying it at less than the expected value from the lessor, and it is reasonably certain that the option will be exercised. That means it is you are very sure that they are going to purchase the asset. The lessor is going to purchase this asset. Okay. So in that case, it is classified as finance lease. Second, the lease term, including any secondary periods, is for the major part of the asset's economic life. What does it mean? Let's say the economic life, okay, the asset's economic life, okay. Major of that life was in the lease, was used as a lease. When you were using a lease, so major of that economic life was under the lease. For example, the asset's economic life was 10 years. For example, okay, economic life of the asset is 10 years, but the lease term was, let's say, 7 years, right? So 3 years it was not on the lease, but 7 years it was under the lease term, the asset's economic life. You see, so major means definitely it will be more than 50%. So the major part is in the lease term. The lease term is like that. The asset's economic life is when they're under the lease term. Okay. including, and this lease term also includes any secondary period. What is secondary period? For example, when you want to extend and something extension, that extension period is also counted. Okay. But if the asset's economic life is 10 years, but it was only for a lease for 2 years, then that's not a finance lease. The major has to be under the lease term. Then only it can be called as a finance lease. Third, at the inception of the lease, the present value of the lease payments amounts to at least substantially all of the value of the lease asset. That means at the beginning of the lease, okay, the present value of the lease payment. What is the present value of the lease payment? That is the at least, okay, substantially all of the value of the lease asset. At least it should be all of the value of the lease asset. It could be even more than that, but it should not be less than that. At least means it cannot be less than that. The present value of lease payment should be more than or equal to the fair value of leased asset. Which date? When you started the lease. Okay. Then it's a finance lease. Leased assets are of a specialized nature so that only the lessee can use them without major modifications being made. Specialized nature, and only lessee can use without major modifications being made. Why is it so? Why is this a finance lease? See, if it is specialized nature, okay, and only the lessee can use, that don't you think it's better for the lessee to buy that asset at the end of the lease term? Because he knows it is specialized, only he can use it, so the lessor cannot even sell to anyone, and no one can take it under the lease because it is specialized and only lessee can use it, right? That particular lessee can use it. So this later, after the lease term gets over, that that leased assets, it will not be helpful for the other lessee who wants to lease the same asset. It will not be helpful because first of all, nature is specialized. Only that lessee can use without major modification. That means you should, without doing some major modifications, only lessee can use it. You are not supposed to change it so much. It's like custom made, right? When you custom made, you cannot sell that. Even if it is not sold to that particular customer, you cannot sell it to someone else. So same way, this lease asset, if it is specialized nature, it is more like a finance lease because they will definitely take the ownership of that asset at the end. It's very likely that the lessee will take the ownership of that leased asset which is specialized. But if it was a common, everyone can take it on a lease and then, but they will not take the ownership of it. They will just take it out for the lease and give back the payment to the lessor. After the lease term gets over, that's it. If it is a common type of asset, the lease asset is a common type. But if it's a specialized nature, it's more likely that the ownership of that asset will be transferred to the lessee at the end of the lease term. Now the lessee will compensate the lessor for their losses if the lease is cancelled. Okay. That means who is having the ownership? Who is having that risk? Lessee is having the risk. Lessee should have the risk. So it's a risk, right? It's a risk for the lessee that he has to compensate the lessor if there's any losses because the lease is cancelled. See, if the lease is cancelled, who is going to lose? Definitely both party will lose. One will lose on the asset, the other one will lose on the amount consideration is going to receive. But who is going to lose more? It is the lessor. Because lessor is not going to get that payment, that consideration amount. So because of that, okay, if the lease is cancelled, lessee has to compensate the lessor for that loss. Okay, so ultimately lessee is the one who is bearing the risk, right? So that since lessee is the one who is bearing the risk, it's a finance lease, right? Next, gain or losses from fluctuations in the fair value of the residual fall to the lessee, for example, by means of a rebate of lease payments. Gain or losses from fluctuations in the, see, when fair value fluctuates, definitely there will be gain or loss, okay, of the residual fall to the lessee. Okay, so if the fair value of the residual fall fluctuates, the fair value of it, residual fall to the lessee. For example, by means of a rebate of lease payment. Then it's a finance lease because the risk or the gain. If it's a loss, it's a risk for the lessee. If it's a gain, it's a lessee is the one who is having the reward. So risk and reward is for the lessee, right? Lessee is the one who is bearing the risk and earning the reward. So it's a finance lease. Okay. Next, the lessee can continue the lease for a secondary period in exchange for substantially lower than market rate payments. He can continue the lease for a secondary period. That means after extension, he can continue that lease in exchange for substantially lower. So they will continue the lease for a very lower amount than the market rent payments. It's a risk, isn't it? A risk for lessee. It's a risk. So again, it's a finance lease. Remember always to identify whether it's a finance lease or not. Always see who is bearing the risk and the reward of that asset, leased asset. Is it the lessor or is it the lessee? If it is the lessee, it's a finance risk. Sorry, finance lease. If it is the lessor, it is an operating lease. This is the easy. In all these examples, the risk is being borne by or the reward is being uh, gained by whom? The lessee. That's why it's a finance lease. You need to go through these points again to understand it. If you're not understanding the sentence, reread it until you understand. But definitely, since with my explanation I've already explained you all the points, I don't think anyone will have any difficulty to understand all those points, right? Just, okay. Now let us go to the finance lease. So finance lease, now once it's recognized, now you should know the initial treatment and the subsequent measurement, how we have done for the lessee accounting, same for the lessor accounting. Now when you are doing this lessor accounting, forget about the lessee. Think about lessor's point of view. You are the lessor, you are giving the lease to someone, you have to think from that point of view. And it's a finance lease. Finance lease means at the end of the lease, you are giving the ownership of your asset to someone. Okay. So at the inception of a lease, the lessor presents assets held under a finance lease as a receivable. Lessor presents assets held under a finance lease as a receivable. Why? Why receivable? I am giving my goods to someone on credit. So that whoever I'm giving my goods to credit, my customer, they are my receivable now. I'm going to get from them a consideration. So they are my receivable. So same way for lease also. Receivable you have to record because you are going to receive the consideration from the lessee. You have not yet received, you are going to receive it in the future. So it's receivable. Okay. Whether you have give the ownership to the lessee or not, this receivable is there. You from your side you have to receive receivable. Remember, again I'm repeating this several times so that you don't forget and don't get confused between the two. Lessee, we recorded right of use asset and lease liability. For him it's a liability. From lessor's point of view, he is the one who is giving that asset, so he is entitled to receive amount consideration. So from his point we are receiving recording receivable. Okay. So the value of the receivable is calculated as the present value of. Okay. So if you see these things, most of these things are similar to what you went through in part 1. Please go and check part 1 if you haven't. And definitely I encourage you to watch my part 1 before you watch my part 2, so that you understand this better. Lessee accounting should be dealt first before you understand lessor accounting. Okay. If you go through this list, all except one additional thing is here, which is this one, unguaranteed residual value. Other than this, 1 2 3 4 5, all this 5 as it is was there under your lease liability. Remember, lease liability payment includes what? All these 5 things were there except this unguaranteed residual value. This is new for the finance lease. Okay. So the value of the receivable, because see, the lease liability of the lessee will be the receivable for the lessor. So it's the same thing. I have to pay someone. So from my point of view, I have to receive a liability. You are receiving. So from your side, you will receive a receivable. But the amount will be same, right? So it now makes sense that these are similar. And also at the present value, because you have not yet received, you will receive in the future. Okay. So it is, that's why it is calculated as present value. Even for the lessee accounting, your lease liability was calculated at present value, right? So fixed payment, that means whatever payment was fixed. Same for lease liability. I'm repeating this again. If you have gone through my part 1 lease liability, you definitely will understand this better. Variable payment, that depend on an index or rate, valued using the index or rate at the lease commencement date. So I'm not explaining each of these things again here. I have already explained in lease liability. Please go check that out. Okay, I'm just going through the list. Residual value guarantee. This I will explain later. Purchase options that are reasonably certain to be exercised, and termination penalties if the lease term reflects the expectation that this will be incurred. Right? So now, but when you apply this point, now you have to think from the opposite side. Before you were a lessee, all this was your payment. Now you are receiving this amount from your lessee. So variable payment you might receive from your lessee. Okay, purchase options. For example, if the lessee purchases your asset at the end of the lease term, and the option is certain to be exercised, then definitely the lessee will pay you the amount. So that is also receivable for you. Termination payment. If the lessee cancels the lease, it's a loss for you. Lessee will pay you for that, compensate you for that loss. So that's why we have a termination penalties also under receivable. Okay. Residual value guarantee. That means below that amount, it will not go. Even if the value of the asset goes down, the lease asset, this is minimum they will pay you, the lessee. So residual value guarantee. What is unguaranteed residual value? We'll go down later. After some time, we'll discover what is unguaranteed residual value, and it is here under the list of receivable. So when you calculate your receivable for finance list, remember you need to add all this. If all these components are there, you need to add all the 6 components. Okay. Subsequent treatment. That was initial treatment. What was subsequent later on? That means usually at the reporting date. So the subsequent treatment of finance lease is to follows. What is it? The carrying amount of the lease receivable. You see, there's a amount for lease receivable. So carrying amount is increased by finance income earned. Same way for your lease liability, when you charge interest on that lease liability, it increases your lease liability. So for lease receivable also, when interest is charged, it increases your lease receivable. But here it is finance income earned. It is not a finance cost. It's an income now because this is lease receivable. So it will be added, which is also credited to the statement of profit and loss. Yes, this is an income, so it will be credited to profit and loss. The carrying amount of the lease receivable is reduced by cash payments. Cash receipts, sorry. Yes, if your customers pay you in cash, your receivable reduces, right? Until it becomes zero when customer pays you fully. Same for lease also. When your lessee pays you, the cash receipts, so your lease receivable will reduce. We definitely have questions for that, but test your understanding we'll do later. The third part of my video will be covering all test your understanding. Now let us go to the operating list. Operating list is much easier than finance list. So a lessor recognizes income from an operating lease on a straight line basis over the lease term. This is very easy. They recognize income. It's an income for them, no? They are receiving the consideration from lessee. From operating lease on a straight line basis over the lease term. You just need to remember this for the lessee. Operating lease. Let's say your lease term is 5 years. So for 5 years, the income you're receiving, divide that by 5. That is the amount of income you're receiving each year. Okay. Here, any direct cost of negotiating the lease. Sometimes there are costs involved to negotiate the lease. Okay. So what should you do with this? Are added to the cost of underlying asset. Yes. It will be added to the asset. That leased asset. So underlying asset should be depreciated in accordance with IAS 16. How do you depreciate? Remember that asset should be depreciated in accordance with IAS 16. And or IS 38 if it's intangible asset. Okay, because that cost, when you're adding to the asset, your asset value goes up. For that additional cost which you have added to the asset, for that you need to calculate depreciation. Okay, so the depreciation you calculate if it is tangible IS 16, intangible IS 38. Okay, the same way how we have done for lazy accounting when we were calculating right of use asset. For that right of use asset, what did we do? We depreciated, right? We depreciated. Here we have to depreciate because why? Under operating lease, remember, you are not giving the asset to the lessee. You are still having that asset, so you need to depreciate that asset. Understood? But with that asset, if you have any cost of negotiating the lease, that will be now added to your asset and you need to depreciate it normally, right? So you are recording an asset, sorry, an income that you are receiving from the lessee and an asset which you are having already, depreciating it. Now lessor accounting. Lessor is a small part, okay? Lessor we don't have so much like in lazy. Lazy was depth. Lessor disclosure, okay? So the underlying asset should be presented in the statement of financial according to its nature. Definitely, you have that asset with you still, so it has to be presented in the statement of financial position. For finance lease, according to its nature. Why did they say according to its nature? It could be a finance lease, it could be an operating lease. If it is an operating lease, how it should be presented? If it is a finance lease, how it should be presented? To finance lease. For finance lease, IFRS 16 requires lessor to disclose the statistics. This is only for finance lease. This 4 points. What is it? Profit or loss arising on the sale. Why? See, for finance lease, again, come back to finance lease. You are giving the asset, you are transferring the asset finally to your lessee. So when you're transferring that asset, that's like a sale for you, right? You're selling that asset to your lessee. So when you're selling, you will have a profit and loss. So that profit and loss needs to be disclosed. Remember, you're not recording it anywhere. The meaning of disclose means you're writing as a note. Okay, that this is the profit relating to this sale. That's it. Disclosure is something, presentation is something. Presentation means you are putting it in the financial statements, either in the statement of financial position or profit and loss, statement of profit and loss and other comprehensive income. Disclose means you are just writing a note, narrative you're writing, you're not putting it anywhere. Okay, finance income, definitely it's a finance income. So finance lease will give you finance income, no, because you are receiving the consideration from your lessee. Data about changes in the carrying amount of the net investment in finance lease. If the carrying amount of the net investment in the finance lease changes, that needs to be there, disclose. Okay, a maturity analysis of lease payments receivable. How quickly are you receiving your lease payment? You're putting it, right? It's like for debtor and all, how you record to see whether your receivables or your customers are paying on time or not. Same we do for the lease also. How fast your lessee is paying you? Under what duration? Are they taking too much time to pay? Are they paying on time? Right? So for that we have a maturity analysis of lease payments receivable that needs to be disclosed. When it comes to operating lease, for operating lease, things are very simple. Okay, why things are very simple under operating lease? Because you are having the asset with you. You are finally at the end you just receive the consideration and you have the asset also with you. That's why it's easy. But finance lease, you are giving the asset to the lessee, so things changes. You know, so that's why finance lease is more area. So for operating lease, lessor should disclose a maturity analysis of undiscounted lease payments receivable. Lessee should only disclose this maturity analysis of undiscounted lease payment receivable. Why undiscounted? Here also lease payment receivable also. Here also you're going to get receivable. Whether you transfer the asset to the leased asset at the end to the lessee or not. Lease payment you anyway will get, no? You will receive from the lessee, right? Under both you will receive it. You will keep on receiving, at least during the lease term, you will keep on receiving it. So for operating lease, you will just receive the lease payment receivable, but it is undiscounted. Why not discount it? You are receiving it every year. You are receiving this payment annually. Every year you are receiving it. It is spread over the lease term. It is spread, the payment is spread over the lease term. Every year you are receiving payment. So that's why you don't have to discount it. It is not something at the end of the lease term of finance you are getting it. Okay. Because it is spread over the lease term. You see here, when we went here. Income from an operating lease on a straight line basis over the lease term. So you don't have to discount it. So it is undiscounted lease payment receivable. Maturity analysis. That means when are they paying? Same for finance also. Now let us go to the conceptual framework example before I touch the next concept, sale and lease back. In sale and lease back, we need two standards. One is IFRS 15 for sale and one is IFRS 16 for lease part. Okay. When developing IFRS standards, both assess whether the benefits of reporting particular information outweigh the cost. IFRS 16, which replaced IAS 17, it was before known as IAS 17, now it is IFRS 16. Radically changed lease accounting by requiring all. How did it change? It radically changed. The changes were very massive, not minute change. Radically changed which one? Lazy accounting. Not the Lessor. Not we are not talking about the finance and the operating. We are talking about the lazy accounting. By requiring all lessees to recognize an asset and a liability at the inception of a lease, unless short term or of minimal value. This definitely you know from your part 1, lazy accounting. We went through that. So now, before it was not there. Before only the lessor recorded finance or operating this, but now it is compulsory. Both lessor and lessee have to do have to account. Lessee has to account for right of use asset and lease liability, whereas the lessor has to account for operating or finance lease. Both the ways, both parties should now recognize under IFRS 16. Before it was not like that. Before it was only the lessor. Now they introduced lazy accounting also. However, IFRS 16 did not change the accounting treatment of lease by lessor. The lessor part didn't change. That remains same. This was because most stakeholders did not believe that requirements relating to lessor in IAS 17 were broken. They think it's still there. They are maintaining that for the requirements relating to lessor. They didn't break it yet, so they think that let it continue. Also, they think that cost will be more if they try to change that area also. Cost will be more than the benefit. So they didn't substantially change the lessor accounting. But lazy accounting, they did. Now let us go to the sale and the lease back. This is the last part of IFRS 16. After that, we'll be doing questions. Sale and lease back. Sometimes what happens, you sell it and then you want to lease it, take it on lease again. Okay, so this time, what happens? Lessee becomes the seller, lessor becomes the buyer. You understanding? Before it was the other way around. Normally, what was it? Lessor is the seller, lessee is the buyer. Now this time it is reversed. Lessor is the buyer and lessee is the seller. You understanding? So it changed, reversed. Now, if an entity, the seller, lessee, transfers an asset to another entity, the buyer, lessor, and then leases it back, IFRS 16 requires that both entities assess whether the transfer should be accounted for as sale. Both entities, not for one. Both entities should assess what? Whether that transfer was sale or not. Whether that is a sale or not. Because if it's a sale, you have to apply IFRS 15. But if it's not a sale, then IFRS 15 you cannot apply. Because IFRS 15 is revenue from contracts with customers. Lease is also a contract only. So for this purpose, entities must apply IFRS 15 to decide whether a performance obligation has been satisfied. Okay, if a performance obligation is satisfied, yesterday we went through IFRS 15 and you know what is a performance obligation, right? I don't think I have to repeat it here. So when you satisfy it, you recognize the revenue. So this normally occurs when the customer obtains control of a promised asset. Performance obligation occurs when customer has the control of that asset. Control of an asset refers to the ability to obtain substantially all of the remaining benefits. What is the meaning of control? Control means you are the one, you are substantially getting all the benefits of that asset is coming to you. That means you are controlling the asset. Conceptual framework. What does conceptual framework says on it? IFRS 16 leases provides a faithful representation of sale and leaseback transactions by requiring preparers of financial statements to consider the economic substance of the arrangement. If a sale has not taken place, the underlying asset should be derecognized. If it is not a sale, don't apply IFRS 15. Underlying asset should not be derecognized because there is no sale. So if no sale, you should still recognize it. You should not derecognize the asset. Understanding? Now we are going to two things. If the transfer is not a sale, if the transfer is a sale, what should you do? How do you know when it's a sale or it's not a sale? See, when you're reading the case study, it becomes hard to apply these things. I know, I can understand. That's why you need to practice enough of question papers until you see a common thing out of this. What is the common thing? What are the facts? What are the common facts they are giving in the case study? You have to see, look out for those things. You have to be very, very aware, right? You have to see, read more and more case studies and see the facts, whether it is leading towards a sale or not a sale. These things you need to find out in the case study. Okay, you cannot memorize from here and go and say that this is a sale or it will not be a sale. You need to look out in the case study for the facts for those things. So today go out after you finish this, after you see my video and you are clear with your concept, go and do a question on it where you have a question relating to IFRS 16, this part. 3 part. Okay, you need to cover 3 parts in IFRS 16: lazy accounting, lessor accounting, lease and sale back. Okay, and lease and sale back also 2 type of questions you need to do. Transfer is not a sale, transfer is a sale. Definitely transfer is not a sale is easy, but transfer is a sale you need to do a question. Okay, so if the transfer is not a sale, okay, IFRS 16 states that if it is not a sale, you still apply IFRS 16. That's the important thing. First of all, if it's not a sale, the seller lazy, the seller, who is the seller now? The lazy, continues to recognize the transferred asset and will recognize a financial liability equal to the transfer process. He recognizes who is having the ownership of the asset, by the way, now. Lazy. Before it was the lessor who has the control. Lazy is using it, now it's the other way around. Lazy. So he continues to recognize the transferred asset. Even if that asset was transferred to whom? To lessor, the buyer. Still the seller recognizes it. The seller recognizes the transferred asset. Let me repeat again. You are the seller. You are selling an asset to someone, but it's not a sale actually. According to IFRS 15, it does not satisfy the criteria to be recognized as a sale. But the asset you are transferring it back to whom? The lessor. Lessor is the buyer. So in that condition, asset goes from you to the lessor, but still you are recognizing that transferred asset. It's not a sale, that's why. You're not selling it to the lessor. So you recognize the transferred asset, and what will you recognize? Financial liability equal to the transfer proceed. There's a liability also. Right? Equal to what? The transfer proceed, whatever the proceed given to you, the transfer. So you recognize transferred asset and a financial liability. What about the buyer? From the buyer's point of view, he will not recognize the transferred asset. Okay, the lessor will not recognize the transferred asset and will recognize a financial asset equal to transfer. He recognizes a financial asset equal to the transfer proceed. Here it's liability, here it is financial asset. You need to memorize it. Okay? So from seller, lessee's point of view, you are recognizing the transfer asset and also recognizing financial liability equal to the transfer process. Lessor, you are not recognizing the transferred asset, but you are recognizing financial asset equal to the transfer process. Okay. To understand why financial liability, how financial assets, see this financial liability and financial asset, it is dealt under your IFRS 9. So definitely this same topic will cover in IFRS 9 also. There you will be able to understand better why it's a financial liability and how it is a financial asset. So, but you generally know, if you have seen my video in IFRS 9, I have made a video on both financial liability and financial asset I've covered. You now should know what is the definition of a financial liability as well as financial asset. Okay. In simple terms. Okay, so now they are breaking this into the simple terms. The transfer process are treated as a loan. That transfer is as a loan they are giving. The detailed accounting treatment of financial asset and financial liability is covered in chapter 12. Chapter 12 is IFRS 9. Right? Okay. Let me explain this way. The reason this is because it's confusing, financial liability and all. Okay. Why he is recognizing a financial liability? I'm not going to go in depth of IFRS 9. I'm not using IFRS 9 at all. But let me explain why it's a financial at least liability we know. So from that point of view, financial liability I can explain. Why the lessee, the seller, recognizes financial liability. If you understand that part, you will definitely understand why buyer recognizes a financial asset. See, from the seller is going to sell the asset to buyer. No, he's selling the asset to the buyer. That means the lessor. So for him, whatever that proceed is there, the sale proceed. For example, they told that they have transferred the asset to the lessor at this amount. So that amount, okay, because it is not recognized as a sale, so that amount is now like a liability for the lessee. Okay, it is like an amount as it's like a liability for that lessee. For the seller, that's why it is recorded as a financial liability. That proceed, whatever they're giving, because that proceed they cannot recognize it as a that proceed, transfer proceed, they cannot recognize it as a revenue because this is not a sale. Otherwise, they would have credit the revenues and debit transferred asset, right? But where to credit? You debit transferred asset, correct? Where to credit? It's like a liability on you now. You haven't recognized it. You cannot recognize it as a revenue because the transfer is not a sale. It's like a liability on you. So that's why you recognize a financial liability. As they have told, the transfer proceed is now like a loan for you. You have taken a loan. Okay, it's like you are giving a loan to someone, you know, or receiving a loan. So it's like that. From the buyer's point of view, buy for the transferred asset, they are recognizing a financial asset. Okay, so it's just the opposite for it. For them, it's like an asset. Okay. Now let us go to the transfer is a sale. If the transfer does qualify as a sale, that IFRS 16 states that two things is there. What is it? One is the seller, one is the buyer. Always you need to look out lease, IFRS 16 whole IFRS 16 you need to look from two point of view. As a seller, that means lessee in this condition. As a buyer, lessor. So the seller, the lessee must measure the right of use asset as the proportion of the previous carrying amount that relates to the rights retained. What does this mean? When it's a sale, that means the seller is selling to the buyer. From the seller, he has to measure the right of use asset. Who is having the right of use asset currently? It is the lessee. who is going to sell it to the buyer. So he must measure the right of use asset, not fully, because he might transfer some of it to the the lessor. So right of use asset as the proportion of the previous carrying amount that relates to the rights retained. So whatever it is retained with the seller, only that much is going to measure the right of use asset. That also relating to the previous carrying amount, proportion of the previous carrying amount. This means that the seller, the lessee, will recognize a profit or loss based only on the rights transferred to the buyer. So he has to recognize a profit and loss because he's selling to the lessor, but only on the rights transferred to the buyer or lessor, the right which has been given to the buyer and lessor. For that right transferred, you are recognizing a profit or loss. If you are retaining something, for that you cannot recognize profit or loss. The buyer and lessor accounts for the asset purchased using the most applicable accounting standards such as IS 16. Okay, buyer is buying the asset. Since he is buying the asset, he uses IS 16 because this is the most applicable for this in this scenario, IS 16. So they use the rule of IS 16 because they have bought an asset. So the lease is accounted for by applying the lessor accounting requirements. So how do you do? After that, you go by the lessor accounting. After that, because he's the lessor, right? That means lessor means what? Lessor means you recognize it either as an operating lease or a finance lease. Okay. So lessor accounting. Transactions not at fair value. See, these transactions might not be at fair value. The one which you are selling to the lessee. Sorry, the lessee selling to the lessor. What if the transactions are not at fair value? Just give it time. Okay. So we are only left with that. Yeah, and illustration. That's it. If the sale proceeds or lease payments are not at fair value, remember sale proceeds or the lease payments are also not at fair value. What should you do? IFRS 16 requires two things. If it is below market value, what should you do? If it's above market value, what should you do? This is an area, this is a very common area which is asked in the exam. So please be prepared for this area at least. It's a very common area. Below market terms and above market terms. If the sale proceeds are below market terms, when the sale proceeds are less than the assets fair value, below market terms means sales proceeds are less than the assets fair value. This is treated as a prepayment of lease payment. Prepayment of lease payment. Okay. If it is above market terms. When the sale proceeds exceed the assets fair value, this is treated as additional financing. Okay. So definitely they will not ask you why and how, you don't need to understand, so you can just memorize it as like this. Below market terms prepayments, above market terms additional financing. So you can just learn it like this. Now let us go through this illustration before I officially end this video and go to part 3 where I'll be solving all your test understanding. So on 1st of Jan 2001, Mosaic sells an item of machinery to Ceramic for 3 million. He sells on this date for 3 million. Fair value was 2.8 million. The asset has a carrying amount of 1.2 million before the sale. This sale represents the satisfaction of performance obligation in accordance with IFRS 15. That means this is a sale. This transfer is a sale. So Mosaic enters into a contract with Ceramic for the right to use the asset for the next 5 years. Annual payment was 500,000 are due at the end of each year. The interest rate is 10%. The present value is 1.9 of the annual lease payment. Explain how the transaction will be accounted for 1st Jan 2001 by both Mosaic and Ceramic. Okay. Now let us go. First of all, you need to understand whether this is above market value or below market value. So the excess sale proceed. If you see the sale proceed is more, this is above market terms because sale proceed was 3 million, whereas the fair value was 2.8. So the excess sale proceeds are 0.2 million. How this will be treated? Additional financing, right? And what was the present value of lease payment? 1.9. It is assumed that 0.2 relates to the additional financing that Mosaic had been given. Okay. The remaining 1.7 relates to the lease. So out of this 1.9, 0.2 relates to the additional financing that they have been given. So that means the remaining 1.7 relates to the lease. Now let us go to the mosaic. Okay, so for mosaic we have, and then for ceramic also we have. Mosaic must remove the carrying amount of the machine from his statement of financial position. What should he do? He must remove the carrying amount of machinery. Let me see who has sold. Okay, Mossack sells. So Mossack is the one who is selling. So he must remove the carrying amount of the machine from his statement. It should instead recognize a right of use asset. Now it should recognize a right of use asset because he has went to a lease. First of all, he sold and then he went back to the lease. So he must first remove and then recognize this one, right of use asset. This right of use asset will be measured as a proportion of the previous carrying amount that relates to the right retained by the Mossack. So how will you measure this right of use asset? This will be measured as the proportion of the previous carrying amount that relates to the right. Previous means before you are selling it to the ceramic, whatever the mosaic has. Okay, so the previous carrying amount that relates to what rights are retained by mosaic, whatever the right that were retained by the mosaic. Okay, so the 1.7 out of that divide by 2.8 because the fair value was 2.8. Okay, 2.8 was the fair value of the building into 1.2. Why 1.2? Because this was the carrying amount before the sale, this 1.2, so which is 0.73 million. Okay, this is the right of use asset. Now let us go to the entry. Okay, so you are selling for cash, that means debit cash. Right of use asset now will be 0.73. We calculated this. Machine will be 1.2 because, and credit machine, that means you are removing that amount from the machine, 1.2. Okay, 1.2 is what it is. The asset had a carrying amount before the sale that you are removing now, that 1.2 credit machine. These liabilities 1.7 credit. So 1.7 will go to 1.7 lease liability. It is this. Okay, you need to remove that additional financing from your lease liability, and this is your lease liability 1.7. Okay, and then we have a financial liability. Financial liability 0.2. How? This is known as financial liability, the 0.2. Okay, how do you know it's a financial liability or financial asset for this person? Who is the seller? Who is the seller? Mossack is the seller. Seller recognizes financial liability. So Mossack will recognize a financial liability credit. Okay, and whatever is balance is profit and loss. Okay, so this is definitely a profit. That's why it's credit. Okay, all your debit should equal to your credit side. Okay, always check whenever you're writing entry whether your debit equals to your credit. It should always be. If it does not, then you need to check your calculations again. Note, the gain in profit or loss is the proportion of the overall 1.6 million gain on disposal. Okay, if you see this gain 0.6, it is in proportion of the overall 1.6 million gain on disposal. What? How 1.6? 2.8 minus 1.2. If you see fair value was 2.8, out from that 1.2 you need to remove. So 2.8 minus 1.2, which is 1.6. Okay, So there is another way of getting the 0.63. That's what they mean, like this. Or you could go through balance the figure. But let us understand. It's important that you understand the second method so that you can check whether it's correct or not. That relates to the right transfer to ceramic. So this 1.6 relates to the right transfer to ceramic. You need to know how much right you have transferred to ceramic to find profit and loss, right? And this much from 2.8 you retained 1.2. So that's why you minus the retained part and to know how much you have transferred. Because 2.8 was the fair value, so 1.6. So you have to take the proportion of it. Okay. So 2.8 was your fair value of asset minus 1.7. What is 1.7? Your lease liability. Your lease liability. Remember, your carrying value of an asset, fair value of an asset will reduce by your lease liability. So minus 1.7 divided by 2.8 into 1.6, which is your profit. So this is the proportion 0.6. You see, hence this is also the balancing figure. Definitely, it's a little bit complicated to understand in first go. So make sure that you keep on doing questions, similar questions if you have over and over again. Okay, just let me go. Now, so the right of use asset and lease liability will then be accounted for using normal lessee accounting, right? Lessee accounting you use for right of use asset and lease liability. Financial liability is accounted for in accordance with IFRS 9. Ceramic will post the following. How will Ceramic do? Ceramic is the buyer. So definitely he will debit the machine, 2.8, the fair value of the machine. And now he will record financial asset. Same amount as financial liability, 0.2, and cash, credit cash, because he will pay cash to Mossack, which is 3 million. So if you see 2.8 plus 0.2, debit side is 3 million, credit side is 3 million, it balances. And how will he account? Lessor accounting only, because lessor is the buyer here. That means either operating lease or finance lease. There are some notes here. The payment or receipt will be allocated between the lease and the additional finance. This is based on the proportion of the total present value of the payment that they present. Okay. So the payment or receipt allocated to the lessee will be this much. How? Why? Because it is based on this. And this payment and receipt, this 52 comes from there, which is allocated to additional finance. This is allocated to lease. And this payment and receipt is allocated to the additional finance. So that means when you add this, you should get 500,000. Okay. Because if you see here, annual payment is 500,000. Okay. So that annual payment, you need to allocate this between two things. Remember, this is a sale. You have two performance obligations. One is the additional financing component, the other one is the lease. Okay. That's why you're dividing it between two. So 500. Okay. 1.7 into 1.9. And 0.2 we know is for additional financing. And 1.7 is for the lease over that 1.9. Okay. So if you see my part 1, you will definitely understand. So that's it. And for lease, now let us summarize everything what I've discussed in part 1 and 2 before I start doing questions. Identify a lease. You need to identify a lease. It's a contract that gives the right to control the use of an asset or an identified asset for a period of time, and for in return you'll be receiving consideration. Lessee accounting. They recognize lease liability and right of use asset unless, that means if the lease is short term, that means 12 months or less than that, or of low value. That means something when you buy it for the first time it's low, then you don't recognize right of use asset and lease liability, otherwise you record. Lessor accounting, they classify the lease as either finance lease or operating lease, and sale and lease back, they determine whether the transfer is a sale or not. If it's not a sale, what you should do, and if it's a sale, what should you do. So you need to go through all this, right? So that's it. And now we'll be going through test, all your test your understanding, right? Starting with test your understanding 1. So this we'll be doing in part 3. So see you in part 3 with test all your test your understanding. Till then, take care and see you with some new exciting. Right, we are very near towards the completion of all our standards. I just have few more standards left. So inshallah, I'm planning to cover this by 5th of August. Then my full time will be on solving the revision kits questions, right? And I'm so sorry that I cannot do revision kit questions now because I'm so busy. My focus is on finishing all the standards by now because it should be there for you so that you can go over it before I actually go through revision kits. Because see, revision kit can be done anytime, right? Standards need to be studied. It takes time to study the standards. Revision kit, last moment you do, it will not harm you because revision kit questions also you will only understand when you have the thorough understanding of the standards. So those standards needs to be there before I go through the revision kit. So revision kit solutions also I will finish by maybe by end of August. I will finish all the questions, right? I'm also trying my maximum, my level best because there are so many questions and also more standards are there. So it's not possible that I simultaneously do both. You can see that my videos are getting longer and longer day by day because the standards are pretty long. There are, for example, group accounting I didn't finish, where we have associate IS 28, then we have IFRS 3, IFRS 10. These standards are pretty long. It will take a day or two for me to finish. So I'm finishing all the individual standards. Okay, the standards which is a standalone standards I'm completing before I touch group accounting because in group accounting has 3 4 standards there together. So I will finish all those standards in a go before I touch group accounting. So group accounting will be something which I'll be doing at the end. Definitely I've done my questions. So through that questions you must have now got an understanding of how you have to do group accounting. So till that, see you.